Michael, good Tuesday morning to you. What about the standoff in D.C.? Is it just me, or do people now say that August 2nd might be just a soft deadline?
Good morning, Susan. Well, I think the damage here has already been done, regardless of the agreement that comes out, unless it's a best-case scenario where we see the US agree to long-term restructuring of its debt situation, a long-term budget reduction and an immediate lifting of the debt ceiling. The outlook for markets remains poor through this, and particularly for the US. The concern here is that regardless of a deal, there is a downgrade coming through the pipeline. But perhaps even more importantly, the confidence of the global markets in the US government to manage its economic affairs has been shaken. And I think the trend we've seen in the US currency, once the reserve currency of choice, 10 years ago, 70% of global central bank reserves were held in US. A year ago, that was 62%. That's now 60%. I expect this sort of event will drive that proportion even lower.
Now, Michael, you say there's been damage, but some are saying, look at the equity markets. They've held up pretty well in light of what's happening, not only in the U.S., but also in Europe. So where's the damage?
Well, they have bounced well. Yesterday, during our session, we saw Dow futures down about 1.5%, and our markets tracked down with that. In China, there were domestic issues as well that added to those 2.5% falls. In Australia, we saw a 1.7% drop. And with the drop overnight in the US market only being about 0.7 to 0.8%, we had some ground to catch up today, and I think that's what we're seeing at the opening of trading.
That's right. We are seeing that at the opening of trading. Are you closely monitoring what Obama has to say in just about 20 minutes' time? Do you care?
It is perhaps the biggest issue facing markets at the moment. We've got a bit of a disconnect in share markets generally. We're seeing very strong reporting from the bottom up. Corporate balance sheets are in very good order, and earnings growth is coming through in Europe, in the US and in Asia. So the bottom up story in share markets is very strong. But these global headwinds, whether it's a European debt situation or the current US negotiations, are what's really driving sentiment, and they've weighed on markets very heavily. I don't think we'll see a solution announced in 20 minutes' time. I suspect that we will see Mr Obama turn up the pressure on the Republicans. He'll be trying to apply political heat to get them to come across the line in terms of increasing taxes.
Okay, well, let me be more specific then. Does it matter to you which plan is agreed upon, whether it's a $1 trillion in cuts or $2 trillion in cuts?
It matters a lot. What I'm looking for here is a systemic approach, something that is a long-term plan to reduce the current level of US debt. At 93% of GDP, it is a threat, not only to the rating, but to the US economy and to its growth prospects. So a long-term plan, a roadmap, if you like, would go a long way to allaying markets' fears. If we don't get that, if we only get a $1 trillion cut and a temporary lift in the debt ceiling, I think the reaction in markets could be quite negative.
Okay. Let me ask you one more question before I let you go, Michael, because take a look at some of the low-volume trading we're seeing in the U.S. ahead of some sort of agreement in Washington. What has to happen, besides an agreement in D.C., what has to happen before investments and investors will get back into the market in a large way?
Well, we're remembering that we are in the Northern Hemisphere summit at the moment. We would expect volumes to be down anyway, but this added uncertainty has certainly depressed those volumes further. What we need to see in the US is a fall in unemployment. That unemployment rate at 9.2% is the key factor in the markets thinking about the health of the US economy. Until we start to see unemployment tumbling, there won't be a lot of reasons to jump into the market. Having said that, the bottom-up metrics are good. I do expect investors are putting their toes in the market already, but we won't see any boom anytime soon until that US unemployment rate falls.